Hi everyone, welcome back to Saheb Academy. Today in this video we are going to understand the concept of markup and margin, and we'll see how to calculate this with a formula. And then the most important thing is the interpretation. You should be able to understand once you know how to calculate the markup and margin. Okay, what is the interpretation you can get out of this? That's very important, and we are going to see that with a beautiful example. All right, so let's start the video and let's get into it. Now, before getting into the concept of markup and margin, let's just understand these three things of the income statement: revenue, cost of goods sold, and gross profit. It's very simple. See here, revenue is the income you earn by selling your products and services, the main inflow that the company has, the business has. Okay, that's revenue. And then what is cost of goods sold? It's really simple. As the name says itself, it is the cost of the item which you have sold. For example, if you have sold 5 umbrellas costing 100 rupees each, so that 100 is the cost price of the umbrella. Cost of goods sold would be, how many have you sold? You have sold 5. So 5 into 100, that's 500. 500 rupees would be your cost of goods sold. And in your stock, in your store, you have so many umbrellas. Let's just say you have 100 umbrellas, but that is not part of cost of goods sold. Understand, it is the cost of acquiring or manufacturing the products that a company sells. Okay, not what it has, sells during a period. Fine, that's cost of goods sold. And then gross profit. What is gross profit? It's nothing but revenue minus cost of goods sold. Okay, so basically if you're from a known financial and non-accounting background, then you can think like this: this is sales, this is cost, and this is profit. Okay, simple. It is the revenue business has left after paying all direct expenses related to the manufacturing or acquiring of a product. So basically revenue minus cost of goods sold. Let's see another example. See here, let's say there is a stationery shop which has sold one scientific calculator. The cost of that is 400 and the selling price is 1000. And here we have this income statement or statement of profit and loss. What's happening over here? We have taken revenue. What's revenue? As you know, it is the income that the business earned by selling their products and services. So how much this stationery shop has earned by selling of this one calculator? 1 into 1000, that's 1000, right? And then what is COGS? Cost of goods sold. Cost of goods sold is 400 into 1 because it has sold only one scientific calculator. But let's just say in the stock, in their shop they have 100 calculators. That will not be a part of cost of goods sold. So 1000 minus 400, gross profit is 600. Okay, so to be exact, here we are going to understand gross markup and gross margin. Okay, so let's start now. Now here we have the concept of markup and margin. It's really simple and straightforward. See here, the first thing that you should take out of your mind is that markup and margin are amounts, rupees, dollars, or whatever. No, it's not. Markup and margin are not equal to amount. Is that clear? Simple. So what is markup and margin? Markup and margin are nothing but just profit percentages. Markup is also a profit percentage and margin is also a profit percentage. What does that mean? It means that with these percentages you can calculate gross profit. Okay, with these percentages you can calculate gross profit, the same gross profit. Here also you will get the same gross profit, here also you will get the same gross profit. That's what you can do with markup and margin. You can calculate the profit. Okay, but the percentages will be different. Markup percentage and margin percentage will be different. Markup percentage will always be higher and margin percentage will always be lower than the markup. Is that clear? That's what will happen. Now, why is it called differently if both of these are profit percentages? What is the difference? The difference is that markup's friend is cost of goods sold and margin's friend is revenue. Okay, this profit percentage, now in the case of margin, profit percentage is on revenue, and here in markup's case, gross profit percentage is on cost of goods sold. See the formulas over here. Markup is equal to gross profit divided by cost of goods sold into 100. Margin is equal to gross profit divided by revenue into 100. See, the base over here is cost of goods sold, and in the margin case the base is revenue. That is the difference. That is why it's called as markup, and here this is called as margin. Okay, so now let's just see the meaning over here. See, markup shows how much more your selling price is than the amount you spend to produce them. That's what your markup shows. Okay, how much more your selling price is than cost of goods sold you spend to produce them. Don't worry, We will see this practically with an example. You will be, totally clear with this. Don't worry. Here you're just understanding a little bit concept and you're getting an overview of this. Then see here, margin shows the revenue earned, how much revenue you have earned after paying the cost of goods sold, after paying the cost of goods sold, okay, the direct expense. Fine. So basically markup and margin are what? Two different ways of calculating the profit. In both the cases, what you're doing with markup and margin, you are able to calculate profit only. You're able to get to profit only, gross profit only. But just the calculation is different. Yeah, the rates are different, the calculation is different here. So basically markup and margin are two different ways to look at the same profit. Yeah, if for example, let's just say gross profit is 100, then you will have two percentages, markup and margin. And when you will use those percentages, different percentage, yeah, markup is, let's just say, something else and margin is something else, then you will arrive at the same gross profit only, at 100 only, 100 or whatever the gross profit is. Okay, so let's take an example and let's see this practically. Then only you will be totally clear with this. Let's take an example. Now here we have our beautiful example. Let's understand. It's really simple. Let's say you have a sports store and you have purchased a skateboard for 1,500 and sold to this person for 2,000 rupees. So simply you can understand, if you have sold for 2,000 and 1,500 is your cost, then 500 is your profit. Is there a doubt? No. Simple. So now if you say technically, then that would be your gross profit, isn't it? Revenue minus cost of goods sold, 500 is your gross profit. Yes. So now let's calculate markup and margin. The first step for calculation of markup and margin is you should have, all the data. So the first step would be to calculate the gross profit, which we just did, right? Gross profit is revenue minus COGS, 2,000 minus 1,500. That gives you 500, which is your gross profit. Fine. Now use the formula. You already know the formula. Gross profit, okay, in both the formulas the numerator is same only, gross profit, because markup and margin are what? Gross profit percentages. So numerator will always be the same. Denominator would be different. Markup's friend is cost of goods sold. Markup's friend is cost of goods sold, cost. So that is why the denominator is cost. Okay. So see here, find markup. Just plug the value. See here, 500 divided by 1,500. 500 is the gross profit and 1,500 is the cost of goods sold. If you put that in the calculator, 500 divided by 1,500, that gives you 0.333. Now markup is in terms of percentages, so you have to multiply by 100. That gives you 33.33%. Okay, so 33.33% is what? 33.33% is your markup. 33.33% is markup. Now let's understand, how can you use this markup? How can we use this markup? We can use this markup to calculate what? The gross profit. To calculate the gross profit. I told you now, while explaining the concept of markup and margin, that these are gross profit percentages. You can use them to calculate gross profit. You can use them to calculate gross profit. How can you calculate gross profit? You have to use this percentage on what? On COGS, on cost of goods sold. Why? Because markup's friend is cost of goods sold. Markup's friend is cost of goods sold. 1,500 is the cost of goods sold into 33.33%, that you can take in decimals as 0.333, right? So that would be equal to 499.95. Yes. So if you round that up, that will be 500 rupees. So 500 rupees is your gross profit, isn't it? Yes. So you can see clearly it is proved that 33.33%, this will help you in calculating the gross profit. The condition is that you have to use this person only on cost of goods sold. If you use this person on revenue, then it will not work. It will not work. You have to use this person only on cost of goods sold, then only you will get gross profit. Is that clear? Simple and straightforward. The second thing is the interpretation. What is the idea you get in your mind by seeing this 33.33%? Yeah, what's the interpretation? What is the benefit of calculating this? The benefit, the idea in your mind should be, see here, you should get an idea when you see this person that markup is 33.33%. The idea is, it means you sell your item, you sell your skateboard for 33.33% more. Yeah, this revenue in a 2000, this is 33.33% more than 1500. Yeah, this 2000 is 33.33% more than 1500. That's the understanding here. It means you sell your item for 33.33% more than the amount you spend to produce them. Okay, that's the interpretation. Now if you see this pie chart, this whole pie chart, right, this whole pie chart 100%, this whole 100% is cost of goods sold. This whole 100%, this whole thing is cost of goods sold. Okay, but understand, out of the cost of goods sold, 33.33% we found out to be gross profit. That's our gross profit. So basically it means that 33.33% of COGS is gross profit. Is that clear? Okay, that's what basically it means. Now let's move on to the margin. So how do we calculate the margin? The same way you have to calculate the margin. Okay, first you have to find the gross profit. Will the gross profit change over here? Of course not. It's the same transaction, same activity. How can the gross profit change? Isn't it? The same transaction, even if there are 100 transactions also, the transaction won't change now. It will be same only. The gross profit will be same only. See here, gross profit is equal to revenue minus COGS, 2000 minus 1500, 500, the same calculation, right? After that you will use the margin formula, which is gross profit divided by revenue into 100. Okay, margins, friend, is revenue over here. How will you remember this? That markup and COGS are connected and margin and revenue are connected. When you go to exams or somewhere, you might forget, or even just after watching this video you might forget. See, it's really simple. There is a shortcut to remember this. Okay, in margin there is R, and in revenue also there is R. So these are friends, they are friends. And then the other side you can understand directly. Okay, if margin and revenue are friends, then markup and COGS are friends. Okay, just understand one side, the other side will automatically come to you. You get my point, right? Okay, so let's use this formula and calculate the margin now. So margin, gross profit is 500, the same. Numerator won't change, it's same only. Divide by the denominator will change, that's revenue. So revenue is 2000 divided by 2000 into 100. If we put this in calculator, 500 in divide by 2000, that gives me 0.25 in terms of percentage, whole percentage, that's equal to 25%. Okay, 25% is my margin. So you can clearly see now it is different. Markup is 33.33% and margin is 25%. And I told you while explaining the concept that markup will always be higher than the margin. Always, it will always be like that. Markup will always be higher than the margin. Okay, so now 25%. How can I apply this 25%? The same way how you applied over here now, the same way you have to apply. Okay, you can use this 25% to calculate gross profit, but the condition is you have to use this percentage only on the revenue, only on the sales. Then only you will be able to calculate the gross profit. If you use it on COGS, then you will not get gross profit, you will get some other figure. Okay, that will be incorrect. So see here, 2000 is the revenue. Can you see? 2000 is the revenue into 25% in decimals, that would be 0.25. So that is equal to 500. 500 is gross profit. You see, with both of these different percentages, we are able to calculate the same gross profit. That is what I told you. I told you that basically markup and margin are two different ways to look at the same profit, same gross profit, isn't it? Gross profit is 500 only. So with different percentages, we arrived at the same gross profit. How? The reason is that we used different bases. Here we apply this on revenue and here we apply this on COGS. Clear? Now what is the interpretation of margin? Understand the interpretation of margins here. It means, yeah, this 25%, the meaning of this, it means you keep 25% of your revenue with yourself and remaining 75% is spent on producing the item. Remaining 75% is spent on producing the item. Okay, all right, so 25% is what? It is your gross profit. So that is what you get to keep, and the remaining 75% is spent on producing the item, so that is cost of goods sold. Okay, here also what happened, 33.33% is your what? Gross profit. This is your gross profit, but in terms of COGS. Here it is in terms of revenue. Okay, so that's how it is. But understand from the markups point of view now, this whole pie chart 100% is considered as COGS, and from margin point of view 100% is considered as the revenue. Yeah, the revenue. Okay, now one more thing that is there here, that is sometimes what happen in question is in any question, in any chapter, what can happen, this concept is there everywhere. Okay, in every finance or accounting chapter you will find this. So what will happen is they will give you markup. Okay, they will give you markup and they will give you revenue, and they will ask you to calculate profit. Can you calculate profit? Directly you can't apply this percentage on revenue now, so you have to do something, you know, else, a bit different calculation which you have to understand. Okay, they can also do it like this. They will give you margin percentage. Okay, margin they will give you, and they will give you cost of goods sold, and you should calculate gross profit. How will you calculate gross profit? Can you apply this percentage on cost of goods sold? No. So this is called as a mismatch of information. Okay, so in that case, in case of this mismatch, missing information, you have to do a bit different calculation. So we have to understand the logic and that calculation properly. So let's just do that. Now see, here we have this mismatch calculation. If in any question you have been given mismatching information, now this can happen in any consolidation question or any chapter. Okay, costing chapter also, job costing, batch costing, wherever there is a profit thing now in a chapter, this thing will be there. Okay, so you must understand this properly. So see here, you already know that the friendships, markups friend is cost and margins friend is sales, right? Technically we say cost of goods sold and revenue, right? So see here, two cases can happen. In a question you will be given markup and cost of goods sold. The friend of markup will not be given. If friend of markup is not given, you cannot apply this 33.33% and calculate the profit. No, you cannot directly apply. Okay, if you apply 33.33% on 2000, the revenue, then you will get wrong answer. That would not be a gross profit. So what you have to do? So in this case, what you have to do is understand, see here, you have to apply this 33.33% in a different way. See here, you have to use this formula. Gross profit is equal to revenue. Okay, revenue you have now. So you will take revenue in numerator, divide by 100 plus markup. You will not take 100. Normally you take 100 now. When you multiply 2000 into 33.33%, what's happening? 2000 divided by 100 into 33.33. Yes, that's what happens normally. But in this case, what you will do, revenue divided by 100 plus markup, 100 plus 33.33, then into 33.33. Okay, so let's just see that. See here, how will you calculate? It's really simple. 2000 is your revenue, divide by 133.33 into 33.33. Now what's the logic and everything about this? Let's understand. Here what we assume is, from the markups point of view, from the markup point of view, we assume that, you know, this cost of goods sold, markups friend, is at 100%. Cost of goods sold, cost, we assume it to be 100%. If cost is 100%, then of course the revenue will be more than that. If there is a profit, then of course revenue will be more than that. If revenue is more, then by how much it is more? It is more by, you already know, by 33.33%, isn't it? I already explained this to you. What is the interpretation of markup? It means your selling price. Yeah, you sell your item for 33.33% more than the amount you spend to produce them. So if we assume in markup, we always assume that cost is 100%. If we assume cost at 100%, then the revenue is at how much? 133.33%. 133.33%. Okay, so that is why what we do is we divide the revenue by 133.33%. When we do this now, let me just show you. 2000 divided by 133.33. When we do this, what happens? We get what is 1%. We get what is 1%. Once you have what is 1%, you can easily multiply 1% with any number and get that percent. How much we need? We need gross profit. We know that gross profit percentage is 33.33%. Isn't it? Markup is what? Markup is gross profit percent. Markup is gross profit percent. We have that. That is 33.33%. So just multiply with 33.33. You will get what is gross profit. That is 500. Yeah. Here, because of the decimals, it's coming like this, 499.96. Yeah. So just round it up. That will be 500. 500 is the gross profit. Do you understand? We assume cost to be 100% from the markup point of view. So revenue is more than that. By how much it is more? By the markup percentage. Okay, 100 plus 33.33%. So 2000 revenue divided by 133.33. What do you get? You get what is 1%. Multiply with any number, you will get that percent. But what do we need? We need gross profit here. Calculate gross profit. So multiply by 33.33, you will get the gross profit 500. Okay, you can also calculate COGS. If you want to calculate COGS, then you will calculate it like this. See, 2000 is revenue. Divide by 133.33. This is 1%. This is 1%. What do you want? You want COGS. We assumed COGS to be 100%. So into 100, that gives us 1500. 1500 is COGS. We already know that because I have used the same example. COGS is 1500. Okay, so this is how you do it. All right, now let's come to the margin. Now here what's happening? Now here, see here, margin is given 25% and COGS is given 1500 and revenue is not given. But we need revenue, isn't it? Margin's friend is revenue. We can use this 25% directly on revenue and we can get the gross profit. But in this case, we cannot use 25% on 1500, which is the COGS. Yeah, we cannot use that. So then what we can do? We can do this sort of calculation. See here, what will happen in this case? Here you have to understand one more thing. Opposite assumption is there. Here we assume that revenue is 100%. Here from the margins point of view, we assume that revenue is 100%. Revenue is 100%. Why? Because margins friend is a revenue. So here we make an assumption that always make this assumption that revenue is at 100%. If revenue is at 100%, then of course, if there is a profit over here, then cost COGS will be at how much? If profit is 25%, then of course COGS, the cost will be at 75%, isn't it? Logic now, there is a logic behind this. Here revenue you have assumed to be 100%, then cost is obviously less than that. By how much it is less? By 25% it is less, because this is the profit percentage. Margin is the profit percentage. Margin is the profit percentage. So of course it will be less. Is that clear? So see the calculation now, the same sort of calculation but little bit opposite. See, gross profit is equal to, what do you have? You have cost. So take that in numerator, COGS. Divide by 100 minus margin. 100 minus margin. Why? Understand the logic. See here, cost is given 1500. We have assumed that this is at 75%. So you have to divide this by 75 only to get 1%. Like how we assumed revenue to be here in this case, we assume revenue to be 133.33%. So we divided by 133.33% to get 1%. Here we have assumed, revenue is 100, cost of goods sold is less than that, 75%. We have to divide by 75 only. Okay, 1500 divided by 75 only. So that is 100 minus margin. 100 minus 25, 75. Okay, into margin. Margin is 25. So see the calculation. 1500 cost of goods sold divide by 75. 75 is the what? Cost of goods sold percentage. Cost of goods sold percentage into 25. When you divide now, you will get what is 1%. Then you can multiply and find out anything you want. Okay. So 1500 divided by 75. This is 1%. What do we want? We want gross profit. So multiply with the gross profit percentage which we have, that is 25%. So into 0.25, sorry, not 0.25, 25 only. So that gives me 500. Okay, see, 500 gross profit. You understood? Really simple and straightforward. See the red sentences over here. From markup's point of view, we always assume cost to be 100. We assume cost to be 100. So revenue automatically became higher than that, 133.33%. That's why we divided it like that, got 1%, multiplied with the markup to get the gross profit. Okay, and of course revenue will be more than cost. Okay, from margins point of view, we always assume revenue to be 100%. You see what's happening over here? Understand the pattern. The pattern is markup's friend is becoming 100%. Margins friend is becoming 100%. from their own point of views. It's like that. Okay, from markup's point of view, markup's friend is 100%. From margin's point of view, margin's friend is 100%. So the remaining will be more or less than that, isn't it? In this case it will be more, in this case it will be less. Yeah, see here, of course revenue would be more than cost, of course cost would be lower than revenue. Okay, like this. So this is the logic. Fine. Okay, see here, markup's point of view, cost of goods sold is assumed to be 100% because cost of goods sold is markup's friend, and then add the markup. Yeah, what is the markup? 33.33%. then the revenue is 2000. I'm just showing you over here how it is. And see, from the margins point of view, COGS is 75%. How it is 75%? Because margins friend revenue is assumed to be 100%. If this is 100%, then of course cost has to be less now, because there is profit, and profit is 25. You already know that in the question it's given 25%. Yeah, so 25%. Okay, as you can see, gross profit in both cases are same, but the way of calculation is different. Okay, that's the conclusion, right? So you understood this mismatch calculation. It's really simple. If you have any doubt in this, then please comment down below, or you can message me on Instagram and ask any doubt related to this. Okay, fine. So that's it for this video. See you in the next video. Bye.